Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures holding steady ahead of the Fed rate decision due at 2 p.m. Eastern time today. The Federal Reserve widely expected to cut interest rates at its meeting amid growing signs of weakness in the labor market. This would mark the first rate cut from the Fed since 2024, and traders are betting on more ahead. All eyes will be on Fed Chair Jay Powell's press conference for clues on the central bank's path forward. Plus, China reportedly banning companies from purchasing Nvidia's AI chips. According to the Financial Times, China's internet watchdog has instructed companies to terminate orders for Nvidia's chips. Among the buyers canceling orders, Alibaba, TikTok parent company ByteDance. The decision marks an escalation in U.S.-China trade tensions ahead of a planned call between Trump and Xi this Friday. And during that call, the president will discuss the state of TikTok's U.S. operations. If all goes to plan, the social media's U.S. operations would be acquired by several companies, including Oracle, venture capital firm Andreessen Horowitz, and private equity firm Silver Lake. That's according to Bloomberg. TikTok's ban was set to go into effect today, but the deadline has now been extended until December. The deal calls for Oracle to continue providing cloud services for TikTok. Oracle already works with the company to host user data in the U.S. as part of a multi-billion-dollar partnership that TikTok has dubbed Project Texas. Let's get a check-in on stock futures here this morning. Not seeing much change, not unusual for a Fed day, right? We have seen stocks rallying recently, although kind of treading water over the past couple of sessions on the anticipation that the Federal Reserve will indeed cut interest rates today. But we'll be paying a lot of attention to the press conference to see what might happen after that. So all three major averages, little changed going into the open. Let's dig more into our top stories of the day now. All eyes on the Federal Reserve as investors await the FOMC interest rate decision and updates to the dot plot. The Financial Times reporting China's directed its domestic tech companies, including ByteDance and Alibaba, to not purchase chips from Nvidia. And this coming just days after Chinese regulators say Nvidia violated its antitrust laws. Also, President Trump's in the UK today as a slew of U.S. tech companies announced plans for billions in investments there, mainly focused on artificial intelligence. Joining me now, David Miller, Catalyst Fund's co-founder and chief investment officer and senior portfolio manager, Yahoo Finance senior reporter Ali Kanal at the NASDAQ, and Morning Brief Market Sunrise anchor Ramzan Karmali. Thanks for joining us. So, David, let's get to you first. Your expectations for the Fed, and what do you know, as we know, it's not like Jay Powell's going to come out today and say, we're cutting today, we're cutting at the meeting in December. Here's our exact roadmap, right? So what are sort of the tea leaves that you're going to be looking for? What cues are going to be looking for from the Fed chair?
Sure. So markets seem pretty confident that the Fed intends to cut 25 basis points here and then another 25 basis points in a subsequent meeting this year following that. Now, what we're really looking to from here is the data. If the data justifies further cuts from here and we see some softness in employment or GDP growth, I think that would really be the indication that we're in a full cutting cycle versus these expected 2 cuts that are anticipated.
Okay, and so then from an investing perspective, how are you viewing all of this and whether it's going to continue to be a catalyst for stocks?
Sure. Well, when you look at rate cuts historically and how they've impacted markets historically, they've universally been a great thing when unemployment's low and GDP growth is positive. It's not so clear when rates are being cut because the economy is truly weak. But in this environment, it's giving a very clear green light that it's a good time to invest in equities and it's a good time to invest in fixed income historically when you get this type of rate cutting in a strong economy.
Ali, what are you seeing in terms of the commentary out there for the sort of broad expectations and what's priced into the markets?
Well, as David was saying, that 25 basis point cut is all but certain, at least according to markets. So I think what's going to be important is the policy statement, any major adjustments there, along with the dot plot, the summary of economic projections. Where do policymakers see interest rates headed, not just for the rest of 2025, but also into 2026 and beyond? Because markets right now, over the next 12 months, are pricing in between 5 to 6 interest rate cuts. We just saw that Bank of America Global Fund Managers survey that was out yesterday. Fund managers are expecting 4 cuts over the next 12 months. So are policymakers broadly aligned with markets, or are we set up for potential disappointment there? And that's what economists and strategists have told me when it comes to where we could potentially see some volatility if there's misalignment on that front. Along with the dot plot, we're also be getting updated projections on where the Fed sees GDP ending up for the year, the unemployment rate, inflation, and the recent data has pointed to maybe a stagflationary environment, or at least the start of that. So is that being reflected in the projections? What are policymakers most concerned about? I think that is going to be top of mind for investors today.
And one of the other trades, David, that I know you're looking at going into the meeting today is gold. And by the way, Deutsche Bank this morning out raising its gold forecast for next year to 4,000. So we are still seeing some bullishness. What's your case for still either remaining in or even adding to gold here?
Sure. Well, we run this fund. It's ticker GOLY, the Gold Enhanced Yield ETF. And our logic here as to why we're still very bullish on gold is, A, you have a $1.9 trillion federal government deficit that's now basically embedded in law with the big, beautiful bill. And then you pair that with the dollar weakening against other currencies this year, and then you're really adding gasoline to the fire with countries rapidly adding to their gold reserves and moving off of the dollar ever since 2022. And the combination of those trends is very powerful for gold. So that's really why we're as bullish on gold right now. Even though it's up a lot, we think it's really up as much as it is because of a dollar weakening story, not that gold prices themselves have been going in the stratosphere.
I want to turn to another story that we are watching closely, and that is the continuing negotiations between the U.S. and China, with Nvidia sort of in the middle as a pawn in all of this. As we talked about, the FT is reporting that China's instructed its companies to not buy Nvidia chips. And I recently had the chance to talk to Nvidia CEO Jensen Huang following its earnings and asked him, how necessary is China even for the business? This is what he said.
Every American technology company, for every American technology company, China is important to have. It's an important market. It's also, as you know, it's just really large. It's the second largest computing market in the world. I'm just delighted that President Trump sees the wisdom of American leadership, and particularly at this time where AI is taking off. It's vital that America wins the AI race.
And yet, Ali, the shares, yes, they're down this morning, a little more than 1%, but it doesn't seem as though investors are especially concerned. The shares are still up 30% this year, for example.
Right. And China is an important market to Nvidia, but it is not the most important market. There certainly is a lot of demand here in the U.S. as well, but this does mark a significant escalation. Now, regulators have previously targeted Nvidia's H20 chips. Those were those paired back processors meant to comply with those U.S. export controls. Now the directive extends to the RTX Pro 6000D. That's Nvidia's newest AI chips, customized for China, a lower powered version of its flagship processor, meant to comply with those same rules. But the timing is also notable. Just a few days ago, China accused Nvidia of violating its anti-monopoly law. This comes as President Trump continues to push policies restricting China's access to U.S. chips. At the same time, China is trying to lessen its dependence on U.S. technologies for these exact reasons. And like you said, shares are down slightly in pre-market trading. We did hear from Nvidia CEO Jensen Huang responding to this report. He said he was, quote, disappointed, but understood that China and the U.S. have larger geopolitical issues to work out. He described Nvidia's business in China as a bit of a roller coaster and stressed that the company has guided Wall Street not to factor China into its financial forecast, given the policy uncertainty. And that may be why we're seeing a bit more muted reaction in shares, because even without China, guidance wasn't too bad in the latest quarter. So if this China issue issue is resolved, that could be a further boon for Nvidia down the line here. But like you said, Nvidia once again a pawn in this game between the U.S., China as these trade negotiations continue. President Trump will be meeting with Xi Jinping on Friday. I'm sure this will be a big talking point.
Yeah, and David, I'm curious you in terms of your approach to AI investing at this point, sort of how you're thinking through it, how expansively you're thinking through it.
So obviously, it's one of the biggest trends that we've seen that's likely to be very durable over the next decade, multiple decades from here. So what we're trying to find is those companies where they can very reliably benefit from that trend. So one of the stocks we've been looking to is Arista Networks. It moves really in tandem with NVIDIA's, with the growth of AI, because they're making the networking both in AI and in the cloud possible, both through the software and the hardware networking that they're making possible. And the company has been growing, about 30% over the prior year in terms of top line revenue growth, has very strong margins, similar to an NVIDIA, but there's not as much of a political situation around an Arista as you have in some names like an NVIDIA. And the software revenue that they're likely to generate is much more enduring than what you get from pure hardware revenue when the growth starts to taper.
And finally, let's talk about President Trump's visit to the UK. He's being greeted with a lot of fanfare, not just from officials there, royalty, et cetera, but from companies that are also inking partnerships there, Ramzan.
That's right. There's a lot of pageantry, but it's interesting to note that President Trump isn't in London. He's in Windsor. There have been protests as well, but he has been accompanied by quite a few of the leading names in technology, US leading names. Among them, Jensen Huang, NVIDIA's Jensen Huang, and also Microsoft's Satya Nadella are with him as well. And what the two countries have agreed is a big, what they called a tech prosperity deal. And it's estimated to be worth around $42 billion. And some of the investments that have been promised include Microsoft saying it'll spend around $30 billion expanding cloud and AI infrastructure in the UK. Google's promised almost $7 billion in spending on a new data center and AI research. Nvidia said it would deploy 120,000 advanced chips across the country. So a lot of US investment in the UK. Also, Salesforce has said they're going to invest, CoreWeave as well. So that's good for the UK, but what about the US? Well, on the flip side, the British pharmaceutical firm GSK said it's going to invest $30 billion in US research and development and supply chain infrastructure over the next 5 years. Now, remember, pharma is a bit of a hot topic because of President Trump's threat to potentially, somewhere down the line, to hit these drug companies with 200% tariffs. Well, a lot of companies are already making that move to invest in the UK to avoid that. So that's quite an interesting take. Also, an interesting thing on the tech front, the investment in the UK could be quite significant because just across the water, across the channel in Europe, there's a bit of an uneasy relationship with US tech firms and the European regulators there. And President Trump has often criticised the EU in terms of how they hit US tech firms. So maybe going to the UK is one way of showing, well, actually, we don't need you. We can go to the UK and we can be as prosperous there. Also, the UK is desperate as well for this investment. GDP growth in the 3 months up to July was just 0.2% in the UK. So the economy not really firing on all cylinders. So this investment will be very much welcome here in the UK.
Yeah, great perspective on all of that. Thanks, Ramzan, and thanks, David and Ali. Appreciate it. And you can tune in to Yahoo Finance at 2 p.m. Eastern. We'll have full coverage of the Fed decision, including Chair Powell's full news conference. President Trump and Xi Jinping are set to hold a call to discuss the sale of TikTok's U.S. operations to a consortium of investors. If all goes to plan, the social media's U.S. operations would be acquired by several companies, including Oracle, venture capital firm Andreessen Horowitz, and private equity firm Silver Lake. That's according to Bloomberg. The framework agreement was unveiled by senior U.S. and Chinese officials after 2 days of talks in Madrid. It would create a U.S.-based version of the popular social media app. Under an initial agreement, ByteDance's stake in TikTok would fall below 20% to satisfy a U.S. law that required the company to divest or face a ban in the American market. Once finalized, TikTok's users would migrate to a new app, according to reporting from Bloomberg. The deal calls for Oracle to continue providing cloud services for TikTok and for ByteDance to license the technology behind the app. The U.S. operations would be valued at about $35 to $40 billion. Coming up, we'll catch you down in the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Workday, FedEx, and Unilever. First up, Workday. Shares on the rise after the company hosted its Analyst Day. Several analysts upgrading the stock following the event. An activist investor, Elliott Management, said on Tuesday it has built a stake of more than $2 billion in the human resources software provider. Elliott also expressed confidence in the company, citing substantial progress in recent years. Next up is FedEx. Evercore ISI downgrading the package shipment company to inline from outperform. Analyst Jonathan Chappell cites, quote, ongoing demand headwinds that are likely to provide greater risk to near-term EPS estimates. The stock has held up well recently, suggesting to the analyst, quote, little relative upside to the shares in the near term, particularly if estimates continue moving lower. By the way, this call coming ahead of FedEx's earnings, which are due tomorrow. FedEx earnings tomorrow. Finally, Unilever, the parent company of Ben & Jerry's, seeing a high-profile exit at its ice cream brand. Ben & Jerry's co-founder, Jerry Greenfield, he's resigning from the ice cream company he founded in 1978. He says the brand's freedom to speak out on social issues has been stifled by Unilever. The exit comes as the consumer giant prepares to list its ice cream unit as a standalone firm in mid-November. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, futures searching for direction ahead of the Federal Reserve's interest rate decision due out at 2 p.m. Eastern today. Markets pricing in a quarter-point cut as investors await Fed Chair Powell's commentary. Joining me now, Jason Furman, Harvard University professor and former CEA chairman under President Obama. Jason, it's good to see you. I know you're on the record saying that the Fed should indeed cut today, but is there a risk to cutting as well, given the backdrop?
Absolutely. I mean, we have an inflation rate that is core inflation that's basically 3% and rising. Some of that is tariffs, but it's not all tariffs. So 4 straight years of inflation above target. And while the Fed has a dual mandate, its most important mandate is inflation. So I think they should cut, but there are, unfortunately, they still need to be nervous about both sides of the mandate.
And Jason, I'm always interested in the so-called transmission mechanism, right? When they cut, how does that make its way through to financial conditions, to the economy? We've had guests come on and say financial conditions are already pretty loose right now. As you recently wrote, and as many economists are saying, the labor problem is at least substantially a supply problem. Does cutting rates do anything for that?
Yeah, no, it can't do anything about labor supply. That's related to our immigration. It can't really do anything about stagflation, which is related to our tariffs. But rates still probably are above neutral. We don't really know where neutral is, but it's a bit above them. The unemployment rate is now above what the Fed's long-term expectation for a neutral unemployment rate is. And so some recalibration makes sense. But you're right. I mean, one reason that I do not think they need to think about 50 basis points is you have a booming stock market, a weak dollar. Both of those are expansionary. Long-term rates have been coming down. That's expansionary. So there's a lot of expansion in the pipeline. And that's before even talking about fiscal policy, where the deficit's likely to increase again next year.
I'm also curious about the sort of drama that has been surrounding the Fed, right? Lisa Cook will be there today, so will Stephen Myron after he was confirmed. And I mean, these are human beings, right? You have to imagine that there is going to be a little bit of tension, or, that they can't ignore all of this is going on. How do you think that affects the sort of decision-making process?
I think the Fed's been good about not letting the drama get to itself. I know some people are like, don't cut rates because it'll look like you're in the pocket of Trump. Other people are like, oh, make sure you cut rates, otherwise he'll take away your independence. I think they're ignoring both sets of those advice and just doing what they would do if there weren't a lot of noise out there. There is some drama in terms of these picks and the like. I don't like what President Trump did to Lisa Cook, But at least the courts are the ones who are making the decisions right now, and everyone is agreeing to abide by the courts. And I hope they continue, to make the types of decisions they've been making. But the most important is that everyone agrees, who decides the law in this case. There's no debate over that.
And as for Stephen Myron, during his confirmation hearings, we're used to talking about the dual mandate of the Fed. He talked about a third mandate. What he said was the goal of moderate long-term interest rates. I guess that sounds good on paper. But what are the implications of that, and what kind of message does that send that he talked about that?
Yeah, look, that's in the statute. So that's a totally fair thing to note. That has generally been interpreted as price stability, so you don't have big spikes and dramatic movements. I'm sorry, financial stability. So you don't have big spikes and dramatic movements in interest rates. I don't think it's ever been interpreted or intended as much lower interest rates. And by the way, if it was, that means Congress passed a contradictory law, because in order to achieve price stability and maximum employment, that tells you what interest rate you want to have. So if he says, his view, which I hope it's not, is we're going to have even lower interest rates, even though that means above target inflation, because we have to balance these mandates, I think that would be a mistake, and I don't think anyone else in the committee would read it that way.
Jason, I'm curious to get your take on tariffs a little bit further, not just the effect on inflation, where we have seen inflation not decelerate, right, as much as we'd hoped, but also sort of the lack of effect, seemingly, on economic growth, according to most measures. I mean, yes, some sectors have been hurt earnings-wise, but most corporations have not. Consumer spending seems to be holding up, for example. What do you make of that? Look,
I think ex ante, a plausible forecast was that tariffs would take half a point off growth. Growth is very volatile, and it's hard to detect, a change of that magnitude. In part, that's because Trump walked back the most severe of the tariffs. Even some of the ones like 50% on Brazil, tons of exceptions to it. And the other thing to know is we haven't seen the full effects of the tariffs yet. Tariffs basically doubled in August. That's just working its way through the economy. It's not in any of the numbers that we've seen so far. So I expect it already is hurting growth. I don't think there's a reason to expect it's going to be dramatic.
When do you think we should start? I mean, we keep sort of waiting as we've had the tariff back and forth to see the full effect. When do you think it starts to show up more in the data?
I mean, first of all, it's unprecedented. So none of us can be very confident about something we haven't seen happen before. There's things sort of like it, but they're pretty different. 1930s, 1971. My guess is that we're already seeing it. Growth in the first half of the year was 1.5% annual rate. That was a big step down from previously. In part, that was because of the immigration issues that we talked about, but tariffs played a role there. I certainly think by the end of the year, going into the beginning of next year, is when you'll see, more of the tariffs and growth. Most of their inflation effect will probably come earlier than that.
We'll keep an eye out and we'll check back in with you. Jason, thanks so much. Always good to get your perspective.
Good to talk to you.
Thanks. Coming up on Yahoo Finance, opening bid. Our own executive editor, Brian Sozzi, is here with us now. What's coming up, Soz?
Hey, Julie. We're going to dig more really into all things Federal Reserve, because this is Fed decision day, and money is on my mind. I'm really trying to get the Yahoo Finance community prepared to make a lot of money or not lose a lot of money after the Fed decision later this afternoon.
All right. Thanks so much, Soz. Looking forward to it. That does a morning brief. Opening bid coming up.